You've been investing for years, you follow the advice, you buy stocks, you even dollar cost average into index funds. But deep down, you know something isn't working. The market keeps going up, but you're still struggling to build real wealth. Why? Because the average investor is stuck in a system designed to keep them from ever getting rich. And today, I'm going to expose why. We're going to dive deep into the shocking truth about why most investors never achieve true financial freedom, and I'm going to share with you the exact strategies the wealthy use to build generational wealth. Let's start with some cold, hard facts. According to multiple studies, the average investor underperforms the stock market by a significant margin. Over the past 30 years, the S&P 500 has returned around 10% annually, but the average investor only makes about 5% per year. Why? Because of three main reasons: emotions, lack of strategy, and the system working against them. Think about it, guys. A 5% difference might not seem like a lot in the short term, but over decades of investing, that's the difference between retiring comfortably and barely scraping by. It's the difference between leaving a legacy for your children and leaving them with nothing but debt. And the sad reality is, most people are stuck in this cycle of mediocrity, completely unaware of the forces working against them. But I'm here to tell you, it doesn't have to be this way. You can break free from the average and achieve extraordinary results, but it starts with understanding the enemy. The biggest enemy of the average investor is themselves. The cycle is predictable. Markets crash, panic sets in, and people sell at the worst time. Then, when things recover, they buy back in at the top. This buy high, sell low behavior destroys wealth. But why does this happen? Because the media profits from fear. The headlines scream, "Stock market collapse," and investors react emotionally instead of logically. If you ever want to build real wealth, you have to break free from this emotional cycle. You see, the stock market is a game of psychology as much as it is about numbers. When you let your emotions dictate your investment decisions, you're bound to make costly mistakes. Fear and greed are powerful motivators, and they can cloud your judgment, leading you to make irrational choices that can set you back years financially. The key is to develop a disciplined, long-term approach to investing, one that's based on logic and sound principles, not on the whims of the market or the latest news headlines. You see, the stock market isn't just about buying and selling. It's a machine built to extract wealth from the uninformed. Hedge funds use algorithms to exploit retail investors. High-frequency traders make millions in microseconds, and big banks influence policy to protect their own interests. And what about fees? Even a simple 1% management fee can cost you hundreds of thousands over a lifetime. Mutual funds, financial advisors, and even some ETFs take a cut of your gains. The average investor loses before they even begin. The system is designed to make you think you need them, that you can't possibly navigate the complexities of the market on your own. But the truth is, with the right knowledge and a little bit of effort, you can take control of your financial future and build wealth on your own terms. Chapter 4. The Illusion of Diversification. You're told to diversify, right? To spread your money across different asset classes. But what if I told you diversification is a double-edged sword? Most people over-diversify, watering down their returns. The world's richest investors don't own 100 stocks. They concentrate their bets on high-conviction plays. Warren Buffett himself has said, diversification is protection against ignorance. If you want to get rich, you need to think differently. Think about it, if you spread your money too thin, you're essentially betting on the entire market, rather than picking individual winners. You become the average, and as we've already established, the average doesn't get rich. True diversification isn't about owning hundreds of stocks, it's about strategically allocating your capital to assets that have the potential to generate outsized returns. Here's the dirty secret. Even if you do everything right, inflation is eating away at your wealth. The government prints money, and suddenly, your savings and stock market gains buy less. The dollar has lost over 90% of its value in the last 100 years. So if you're just saving and investing passively, you're falling behind. The rich don't just sit in cash. They use assets that beat inflation. They borrow money at low interest rates and invest aggressively in appreciating assets. They understand that cash is a depreciating asset, and they focus on acquiring assets that have the potential to outpace inflation and generate real returns. The middle class is taught to avoid debt, but the wealthy? They use it to their advantage. They borrow money at 5% and invest in assets returning 10 to 15%. This is how the rich scale their wealth. Of course, leverage can be a double-edged sword, and it's important to use it responsibly. But if you're not using leverage at all, you're missing out on a powerful tool that can help you accelerate your wealth-building journey. The key is to educate yourself about different types of debt, understand the risks involved, and use leverage strategically to acquire income-producing assets. So how do you actually get rich? Here's a strategy used by some of the wealthiest investors. Invest in high-growth ETFs like VGT, VUG, and the S&P 500. Use leverage intelligently, borrowing at low rates to maximize returns. Stay consistent. Ignore market noise and invest regularly. Think long-term. The market rewards patience, not panic. The difference between the average investor and the rich investor isn't luck. It's strategy, mindset, and discipline. It's about having a plan, sticking to it, and not letting emotions or short-term fluctuations derail you from your goals. Remember, building wealth is a marathon, not a sprint, and it requires patience, persistence, and a willingness to learn and adapt along the way. So now you know why the average investor will never get rich and how you can break free from the cycle. The question is, will you keep making the same mistakes, or will you start thinking like the wealthy? If you found this video valuable, hit the like button, subscribe for more, and share this with someone who needs to hear it. The road to wealth isn't easy, but it's possible if you take action today.